Hey everyone, and welcome to our Real Estate Explainer. Today, we're going to break down how you can actually build wealth in real estate without completely drowning in dense financial regulations. Seriously, if you've ever stared blankly at a massive stack of mortgage documents, tried to decode the tax code, and felt a sudden, overwhelmingly strong urge to just run away and live in the woods, well, you are in the exact right place. We're going to cut right through all that confusing jargon and use the actual source data to show you exactly how the real estate machine really works. Think of this as your ultimate financial playbook. We are literally going to follow the chronological journey of a real estate dollar. We'll track how a single dollar moves from the broad economic market right into your personal tax return, through the absolute gauntlet that is the closing table, and then even into alternative investments. It's like a giant puzzle, and we're putting all the pieces together. So here is our playbook for today. 1. Measuring housing affordability. 2. Unlocking mortgage tax breaks. 3. Decoding your loan estimate. And 4. Investing without buying property. Let's just dive right in. Starting off with Section 1, Measuring Housing Affordability. Let's look at the big picture data. Before you even think about hitting up open houses or scrolling through online listings late at night, we really need to know if you can actually afford to buy in the current macroeconomic climate. To do this, the National Association of Realtors relies on a highly specific metric called the Housing Affordability Index, or HAI for short. It's honestly a fantastic tool because it takes the highly emotional roller coaster of home buying and grounds it in pure objective math. It essentially asks one very simple question: does the typical family make enough money to buy the typical house? The absolute key to understanding this math is the magic number 100. This is the exact threshold where a family's median income perfectly matches the income needed to qualify for that median-priced home. So if you look at the index and it sits exactly at 100, boom, you have exactly enough income. An index above 100, that means a median income family actually has more than enough, which gives you some real breathing room. But if that index dips below 100, well, that means the housing market is actively outpacing your wallet. Now, to actually hit that perfect 100 mark, the underlying assumptions require putting a full 20% down and keeping your monthly principal and interest payments under 25% of your total income. This is the strict baseline the National Association of Realtors uses to keep their data consistent year over year. But as we all know, saving up a massive 20% down payment is incredibly difficult for most people in today's economy. Which brings us right to Section 2, Unlocking Mortgage Tax Breaks. Let's find those deductions. So what happens when you zero in on a house you love, but you simply don't have that massive 20% down payment sitting in the bank? This is a huge hurdle for so many buyers. Normally, if you put down less than 20%, lenders force you to pay mortgage insurance just to protect them in case you default on the loan. For years, this was nothing but an added, painful sunk cost. But a recently restored tax rule completely changes the entire landscape for low down payment buyers. Get ready for an absolute game changer. The permanent restoration of the mortgage insurance tax deduction lets you completely write off private mortgage insurance, which vastly expands your purchasing power. Starting in the 2026 tax year, the tax code will treat your mortgage insurance just like deductible mortgage interest. This literally takes a frustrating fee that used to just vanish from your bank account every single month and turns it into a permanent, legitimate tax deduction. Now, this is a fairly targeted middle-class tax break. To get the full deduction, joint filers need an adjusted gross income below $100,000, and single filers need to be below $50,000. And the really great news here is that it's not just for conventional loans with private mortgage insurance. It broadly covers FHA premiums, VA funding fees, and even USDA guarantee fees, meaning a really wide swath of everyday buyers can take advantage of this. To put the real tangible impact into perspective, when this deduction was historically active, over 4 million homeowners claimed it, saving a combined $65 billion. Yeah, billion with a B. Deducting an average of $2,364 from your taxable income makes a massive difference when you're budgeting for a new home. It's essentially the tax code giving you a financial cushion precisely when your cash reserves are usually at their absolute lowest. Moving on to Section 3, Decoding your loan estimate. Welcome to the paperwork phase. All right, so you've checked affordability, you've got your tax strategy planned out, and now you're officially applying for the loan. First up, we really need to define TILA RESPA.
This is the regulatory framework designed specifically to protect consumers from hidden fees and confusing loan terms at the closing table. You see, before these rules were rolled out by the Consumer Financial Protection Bureau, buyers were handed mountains of overlapping, contradictory paperwork that practically required a law degree just to decode. Now, the law mandates streamlined, easy-to-read forms.
Did you know an application is officially triggered the second you provide these 6 specific pieces of information to a creditor? Your name, your income, your social security number, the property address, the estimated value of the property, and the loan amount you're actually seeking. This is incredibly important to remember. Once the lender has these 6 things, the law says you aren't just casually chatting anymore, you have officially applied for a mortgage.
And this is where the clock officially starts ticking because the timeline here is legally binding. The moment you provide that specific information, the lender has exactly 3 business days to put a formal loan estimate in your hands or in the mail. No excuses. This rigid timeline prevents lenders from dragging their feet or trying to hide exorbitant closing costs until the absolute last minute, right when you're too stressed out to back out of the deal.
When you look at the official loan estimate document, there are absolutely no hidden formulas. The top section locks in your loan terms, so you know exactly what your interest rate is going to be. The middle projected payment section clearly breaks down your principal, interest, taxes, and insurance. And right at the bottom, the cost at closing section shows you down to the exact dollar how much cash you need to bring to the table. It is entirely transparent and holds the lender fully accountable to you.
And finally, Section 4, investing without buying property. No actual property required.
Okay, let's totally switch gears for a second. What if you want to benefit from the wealth-building power of the real estate market, but you have absolutely zero interest in fixing leaky faucets or managing demanding tenants? Well, Congress actually established real estate investment trusts, or REITs, way back in 1960. They did this to allow individual, everyday investors to earn a share of commercial real estate income without having to buy a whole building themselves. A REIT simply pools money from a bunch of investors to buy large-scale assets like shopping malls, apartment complexes, or office buildings. You essentially just buy shares in the portfolio, much like you would buy a regular stock.
Now, the absolute biggest draw here is what's known as the 90% rule. REITs are legally required to distribute almost all their taxable income directly back to shareholders as dividends. Because of this really unique tax structure, a REIT pays 0 corporate tax, provided they pass at least 90% of their taxable income straight to you, the investor. This makes them a highly attractive vehicle for generating passive, consistent income without ever even touching a hammer.
But, and this is a big but, according to SEC investor bulletins, there are massive differences in how these operate, and you absolutely need to know the caveats. Publicly traded REITs are bought and sold on major stock exchanges, meaning they are highly liquid and extremely transparent. Non-traded REITs, on the other hand, are highly illiquid. You might be locked in for 10 whole years, and they often charge enormous upfront broker fees of 9 to 10%. That means your actual invested capital takes an immediate, hefty hit. It is absolutely crucial to know exactly what kind you're dealing with before you invest a single dollar. So there you have it. We've explored the raw data driving affordability, the tax codes that can literally save you thousands, the strict paperwork rules protecting you at closing, and the completely hands-off approach of REITs. The wealth-building tools are all right there, hidden in plain sight right inside the system. So whether you're signing a massive mortgage document or just buying a dividend stock tomorrow, I want to leave you with this. Do you finally know exactly who is profiting off your real estate dollar?